Hello, I'm Alex Davies, founder of Wealth Club. Today I'm with Matt Curry of Seneca Partners to talk about the Seneca EIS portfolio. Firstly, Matt, tell me about Seneca and also give me some background about yourself.
Yeah, good to be here. Thanks, Alex. Seneca was formed in 2010, really with the ambition of becoming a leading fund manager in the tax advantage space. So within that time, we've raised and deployed over 100 million of EIS and VCT money into over 50 SMEs with a focus on biotech and technology businesses. We're relatively sector agnostic, and alongside our EIS and VCT money, we also manage over 150 million of alternative assets, including property investment and development finance. Myself in particular, I've been with Seneca over 5 years, currently head up our EIS and VCT investment team. I came out of sort of mid-market background, so came through, was trained at Deloitte as an accountant and corporate finance, and then since spent a few years in leverage finance, looking at mid-market private equity deals in the banking world. And really as a result of that, spent a lot of time working with owner managers and found that I enjoyed the younger, more innovative, less mature stage of investing in those businesses. So naturally shifted into the SME world and the early stage investing.
So tell me about the EIS fund. What's it aimed to do for investors? How many companies would you usually get exposure to?
Yeah, quite frankly, the overall aim is to deliver returns and make money for investors. Naturally, alongside that, tax reliefs come along with that in the EIS and VCT landscape. But fundamentally, the investments themselves have to stack up without those tax reliefs. So we aim to deliver 1.6 to 1.8 times return for our investors. We're currently tracking towards the top end of that at 1.8 times. Within that, we give our investors exposure to a minimum of four investee companies. Top end of that's probably 6 investee companies. And we aim to give them a nice spread of public and private businesses with a focus on the AIM market as well as the private deals. Very much sector agnostic, which gives us the opportunity to really pick segments of the market that we see the most value in at any given time.
And talk to me the characteristics of the particular companies you look for.
Yeah, so I think the overarching theme will always be, in this space, will always be high quality management teams. That won't surprise you. We work closely with founders and management teams within our investee companies and within our portfolio as a whole. As I mentioned previously as well, we do have that 50-50 split with public and private deals. Around half our money goes into AIM businesses, which naturally come with a little bit more professionalism, more mature businesses, quite often larger funding rounds. So in terms of our focus as an investor, it's very much kind of later stage, avoiding startups and backing management teams with a proven track record.
And how do you find these companies and why do they come to Seneca?
So a lot of them come through existing Seneca network, and they're kind of the usual routes of accountants, bankers, lawyers and contacts within that SME landscape and non-execs who've worked with these businesses previously. An awful lot actually come out of our investor base. We're very engaged with our investors, and they'll regularly refer businesses and opportunities to us. We work closely with our corporate finance team as well, who are helpful in terms of identifying these opportunities or working with high net worths, angels who can really add value to these businesses and regularly come to us with investment opportunities in this space. As I mentioned previously, around half our money goes into the AIM market, so an awful lot of our deals come through the AIM focused broker network, and even on the private side we're seeing more and more of these brokers now having pretty solid and high quality corporate finance offerings, so they'll obviously bring to us, by virtue of our track record on AIM and pre-IPO rounds and this kind of thing, will bring to us earlier stage opportunities and pre-IPO rounds as well as the IPO and secondary fundraising market as well.
Okay, and What's sort of the typical ticket size you're writing? I know, how does that compare to the overall round? And, how many deals are you doing per year?
Yeah, so we probably get involved at a later stage than some managers in the EIS landscape. We probably have a minimum check size of around about 500k and cap out at somewhere between 2 and 3 million. That leads us towards slightly more mature businesses than sort of some of the operators in the market. For a typical round size, I mean, they may well be £1 million funding round from Seneca and 100% of it's coming from Seneca. Alternatively, particularly on the AIM market, some of those might be a 500k check from Seneca that's going in alongside 20-30 million pounds of relatively significant institutional funding. So as you can see from those metrics, some of the businesses that we're able to support through our EIS offering are vastly different than some of the earlier stage stuff.
And how many deals are you doing a year usually?
So we probably do somewhere between 10 and 15 deals across our EIS and VCT offerings. The bulk of those are co-investments from both pots of cash, and there'll always be a spread of new opportunities and follow-ons, which is an area that we like to deploy cash into. We see follow-on funding rounds as a safe place to put our money with management teams, sectors and businesses that we know well.
And do you want to talk to me about some of the recent investments you've made?
Yeah, so when COVID hit in March 2020, we made the conscious strategic decision that there was value out there in the AIM market, and that's an area that we've had significant success in over the last 12 months. A couple of investments just to pick out would be our investment in Skin Biotherapeutics, which we invested in October 2020, and that was supporting an existing Seneca EIS and VCT portfolio company that we supported along its journey over the last 3 or 4 years, right through from its original spin out from Optibiotics. That business has got a diverse suite of IP focusing on the gut skin axis. So really getting into the teeth of how what you eat and what you take into your body can have a material impact on other areas of your body and your skin and your hair in particular. So they've got a broad, diverse range of IP focusing on 5 core areas of the business. The first 2 of those are now approaching commercialisation, so that business has really picked up over the last 6-12 months. Another area, another business on AIM that we've had some success in will be a business called Polarian Imaging. They specialise in lung scanning, MRI lung scanning, which obviously over the last 12-18 months has been quite a core offering within the biotech and medtech landscape, and that's a business that's now coming to fruition and expecting its final FDA approval in the coming months, which should be a material value inflection point if they can achieve that.
And companies you've backed a bit earlier on, how are they doing?
Yeah, so I think a great example that you might have seen in the press would be our investment in Wejo. So we invested in that business in 2016 originally and have subsequently supported that.
What does Wejo do?
Wejo deal in the connected car space, so a lot of data management alongside the OEMs, the car manufacturers. So they're a Manchester headquartered business, raised significant money from the likes of General Motors along the way, and are now partnering up with Microsoft and various others to deliver a NASDAQ SPAC deal, reversing into a cash shell on NASDAQ, just over $1 billion. In terms of valuation, so that's Seneca's first unicorn and something we're incredibly proud of.
So post-investment, what does Seneca add?
Yeah, so there's naturally a layer of professionalism that we can bring to the table. The Seneca network being extremely vast, we're always going to have access to chairman, non-exec who can add that to businesses. But I think the key area really is, we see hundreds, if not thousands, of these businesses every year. And we've tracked and seen those journeys over a number of years to the point where we've got a real feel for how these businesses are evolving, how they're developing, and what that next leg of that journey should look like. So it can be very a very subtle difference between raising your next funding round slightly too early or potentially leaving it slightly too late to the point you're a little bit on the back foot. So that's the kind of area where we feel we can bring a lot to the table. Naturally, a lot of these businesses are cash hungry, so having that balance and that strategic sounding board there to help owners, managers, founders who potentially haven't been on this journey previously, that's an area that we can deliver real value.
And have you had any exits yet?
Yeah, we've had a number of exits. So we've exited 22 of our portfolio companies over the last few years. A recent example would be Mission Labs, a business that we sold in March of this year. That was a business that we supported just over 3 years ago and helped them through the journey. The business had two core products at the time we invested. One was very much SME focused, one was more large corporate focused. So they're a cloud-based telecom solution provider, but also branching out into the world of call center technology and voice recognition and AI bot technology to help support retailers and large call centers serve the needs of the customers slightly better. So that was a business we invested £1 million in 2018 and exited in March this year through a trade sale to a PLC buyer, over 5 times return for our investors.
Yeah. And it's quite a short time period. What is the typical time period you'd be looking to exit a business?
Yeah, I mean it's another area where we lean quite heavily on our AIM exposure. I think the industry as a whole has probably trended from 3 to 5 years, 5 to 7 years, and now occasionally quoting 8 to 10 years in terms of exit horizons. What AIM gives us is the ability to exit a portion of an investor's portfolio in that 3 to 5 year window, whilst continuing to back your private winners or potentially public winners, as and when the timing's right for those businesses to be acquired.
And how risky is it? And if you look at a typical portfolio, how many would you be expecting to do well? How many would you expect to fail?
Yeah, so I think as we touched on, our typical investor will have access to a minimum of 4 up to 6 investments, and within that there'll always be an element of businesses that don't perform as planned. So I would urge investors to expect failures to some extent. Naturally, we try and keep that to a minimum and kind of steer things in our favour and allow our investors to benefit from kind of enhanced legal terms or various other bits and pieces that will enable us to strike the best deal for our investors, whether that be a positive exit or potentially an accelerated downside exit, and that's kind of another area where we look to add value to our investors.
And obviously it's been a funny year or 2 years. What are the challenges you're facing as a manager?
So it's been a roller coaster. I think the one area that we're seeing the most challenge is really getting a feel for which businesses are going to succeed over the next year, 2 years. If I look across our current portfolio, we've had businesses that have been impacted materially on the downside. We've also had a number of businesses that have benefited significantly from COVID, and within that there's businesses that have been affected kind of in the immediate term and sprung straight back and will be in a great position going forward. So it's really dissecting what is normal trading and where that underlying value sits, and trying to get a feel for that to the point where we can strike the best deal, whether that be a follow-on funding round, whether that be supporting a new business or a new sector, in terms of dissecting what that real value is currently and will likely be in a year or two's time.
So finally, if I want to put money into an EIS this year, just succinctly tell me why should I choose you?
Yeah, so I think the key points I'd bring out is Seneca's investment exit track record. We've returned over £30 million of exit proceeds to investors across 22 exits. So that record kind of speaks for itself. And with the EIS landscape constantly evolving, it can be difficult to kind of cut through a lot of the information you're being given to the point where you really get a feel for who's good at this and who's going to deliver that money back into your pocket as an investor. On top of that, I would also point to our AIM exposure. We aim for about a 50-50 split of public and private businesses, which is something that's not seen massively throughout the EIS market, and can give you, as an investment manager, can give you the ability to really manage exposure and an exit process to the point where you can de-risk investments and deliver cash returns to investors along that journey.
Matt Curry of Seneca Partners, thank you very much.
Thanks, Alex.